we've seen a lot of people rushing into corporate bonds as everybody in the world tries to get some sort of yield here. Is that a smart move at this point? Are people taking too much of a risk, using it maybe as a proxy for sovereigns?
Well, Mike, it's a quick formula. You figure out what the spread is. Let's take high yield at 450 basis points. You figure out what the annualized defaults will be in the recoveries. Let's say 4% with a recovery of 50%, and so that takes 2 points off the 4.5, so that leaves you 2.5%, relative to your treasuries. That's not a bad deal, but it's not the deal that investors think they're going to get. And if we have problems elsewhere, like we've been talking about, then certainly those spreads are going to widen out. I think it's obvious that when interest rates are at zero or negative, that everything's tied together. The thigh bone and the knee bone and the hip bone and junk bonds and stocks and negative interest bonds are all tied together in some way. And so you must assume, I think, that the high yield bond area is artificially priced and at risk under certain circumstances. I wouldn't buy them.
Well, effectively,
matter of fact,
go ahead.
Matter of fact, I'm short them. I'm short them.
Across all categories of corporate, or just high yield?
No, there are CDX, which is an index of high-yield bonds, and an IG CDX, which is an index of investment-grade bonds, and those are derivatives that are easily traded. The IG CDX trades at about 80 basis points. The high-yield, basically at about 425. And so, yes, when you buy protection as opposed to sell protection, which I've done, that's the same as shorting. Then you're giving up that carry, but you're looking for a widening of spreads, and I think ultimately that's what happens in both of those markets.